Today we're going to talk about the MACD. No, not this MACD. This MACD, the Moving Average Convergence Divergence. Now the MACD is a very popular technical indicator. In this video, we're going to explore how it actually works. And based on how it works, let's discuss whether or not it's actually a useful indicator. Alright, so there are 5 main components to the MACD indicator. For simplicity's sake, we're just going to use the default settings for the purpose of this video. The first component is the short-term moving average. By default, this is the 12-period moving average on the price of the stock, of the security. The second component is the longer-term moving average of the price, and normally by default, this is set at 26 periods. The third component, also the main component of this indicator, is the MACD line. Basically, this is the difference between the two moving averages that we have on the chart. It is the 12 moving average minus the 26 moving average. In this example here, the 12-period moving average is 152.31. And the 26 moving average here is 149.89. So the MACD number that we derive is the difference between the two, and it's 2.42. Let's take a quick look at another example. Over here, the 12-period moving average is at 152.42. And the 26 moving average is at 153.91. That will make the MACD line negative 1.49. What we see here is that if the MACD line is above 0, if it's positive, that means that the 12-period moving average is above the 26-period moving average. If the MACD line is above 0, is positive, and it's sloping upwards, this tells us that the 12-period and the 26-period moving averages, they are moving further apart. The gap between them is actually widening. This is an indication that prices are increasing. If the MACD line is positive but sloping down, this tells us that the 12 and the 26-period moving averages, they are actually coming closer together. The gap between them is now narrowing. And what this means is that the momentum of the price, it could be slowing down, or the prices may even be falling. Now, when the MACD line is negative, this means that the 12-period moving average is actually below the 26-period moving average. When the MACD line is negative and sloping down, this tells us that the 12 and the 26-period moving average, they are moving further apart. The gap between them is widening. And this happens when prices are moving down. Whereas if the MACD line is negative but sloping upwards, this means that the 12 and 26 period moving averages, they are coming closer together. The gap between them is narrowing. And when this happens, we see that the price downward momentum is slowing down, or the prices could actually be moving upwards. If that's a lot to take in, you can pause here to absorb it before we move on to the next component. Alright, the fourth component. This is a bit more simple. This component is known as a signal line. And this line is basically the 9-period moving average of the MACD line. Now, sometimes there may be a fifth component in the MACD indicator, which some people use, and that is represented by a histogram bar chart. Basically, what this tells us is the difference between the MACD line and the signal line. Alright, so we have established what are the 5 components that make up the MACD indicator. Now, there are a number of ways that the MACD indicator can be used. But in the interest of time, today I'm just going to talk about 2 of them so that we can kind of see how this indicator functions. Alright, so the first set of trading signals is provided when the MACD line crosses 0. The conventional wisdom or the conventional way to trade this signal is that a buy signal is triggered when the MACD crosses above 0, and a sell signal is triggered when the MACD crosses below 0. Now let's unpack that for a minute and see what it actually tells us. So earlier we have established that the MACD line is basically the difference, the space, the gap between the two moving averages, the 12 and 26 moving average. So at the point of times when it crosses 0, Basically, this is where there is no gap between the two moving averages. This is the point where the two moving averages are actually crossing one another, as we can see in this chart. In other words, what the signal is actually telling us when the MACD crosses the zero line is the same thing as when two moving averages are crossing one another. So I don't know about you, but if I'm going to be trading moving average crossovers, which I don't, but if I'm going to do that, why do I need another indicator to tell me what I already can see for myself? If I just look at the chart, I put in the two moving averages, I can see where they are crossing over. So if the whole point of using the MACD indicator is just to trade when the MACD crosses zero, what's the point? I mean, I can just look at the two moving averages, can't I? Basically, it's a bit of an overkill. Now, the second category of signals are generated when the MACD line and the signal line crosses each other. Now, there are 4 different types of scenarios that can happen here. So let's unpack them one at a time so we can understand what is actually happening when the MACD line crosses the signal line. The first crossover is when the MACD line crosses below the signal line when the MACD line is above zero. Now, this is conventionally known as a very strong bearish signal. It means that if you see this signal happening, you're supposed to sell. Let's unpack this signal, alright? So the MACD line is above zero, and this means that the 12 period moving average is above the 26 period moving average. The MACD line now is sloping down, which means that the gap between the 12 and the 26 period moving average is narrowing. And when it crosses the signal line, that means that it has narrowed to a point where it's below its 9-day average. Now, if we remove all the indicators from the chart, and we just look at the price by itself, does this look like somewhere where we would be looking to sell? I don't know about you, but it kind of looks like this stock could be in a strong uptrend. I'm not sure if I would want to sell at this point in time. The second type of crossover is when the MACD crosses above the signal line when the MACD is above zero. Now, this is conventionally known as a moderate bullish signal. So when you see this, you're supposed to be thinking about buying. So the 12 period moving average is above the 26 period moving average, and the gap between them is widening. Right now, it has widened to a point where it has increased above its 9-day average. But once again, when we remove all the indicators on the chart, does this look like a price that we may be comfortable buying this particular share? I'm not sure if I would be comfortable. The third kind is when the MACD line crosses above the signal line when the MACD line is below zero. Now, conventionally, this is known as a strong bullish signal. When you see this, you're supposed to buy now. But let's unpack what this signal actually tells us. The 12 period moving average is below the 26 period moving average. But right now, the space between them is narrowing, and it has narrowed to a point where it's below its 9-day average. So here is where we get a strong buy signal. But if we remove all the indicators from the chart, we kind of see a stock that is moving in a strong downtrend. Now, I don't know if I'm going to be comfortable with buying this share at this particular point in time. Now, the last type of crossover is when the MACD line crosses below the signal line and the MACD line is below zero. Now, this is a moderate bearish signal. So you see this, you're supposed to think about, time to sell. The 12 period moving average is below the 26 period moving average. The gap between them is widening, and it has widened to a point where it's wider than its 9-day average. If we remove all the indicators from the chart, the market looks like it's, reaching a low point. I don't know about you, but I'm not sure if I'm going to be comfortable selling right here. Alright, so I've given you a brief overview of how the MACD actually works and what the signals are actually telling us. I think it's very, very important if we're going to use a tool, if we're going to be using a technical indicator, that we understand how it works. We understand what it's actually telling us. Rather than, this financial guru said use the MACD, or no, my broker say use the MACD, so I just use it. No, I don't think that's wise. I think, when every financial decision that we make, whether we're going to buy or whether we're going to sell, we have to be convinced of the reasons why. We have to know, why are we doing this? Why are we buying? Why are we selling? So moving forward, I hope that when you see such signals on the MACD indicator, you actually think carefully about what it's trying to tell you. There are more ways that the MACD indicator can be used, but for this video, I'm just going to be talking about these two because I think I've given you enough information for you to consider for yourself if the MACD is actually a useful indicator. So with that in mind, I don't use the MACD indicator, and here are some more reasons why. Firstly, the input parameters for the MACD indicator being the 9, 12, and 26 period moving averages. These numbers don't correspond to anything meaningful. When this indicator was first used, I believe that was in Japan when they had 6-day work weeks. So the 12 period moving average will correspond to 2 weeks of data, and the 26 period moving average corresponds to around 1 month of data on average. But now in 2022, if we're looking at the US markets, they are open for 5 days a week and on an average around 22 days a month. That means that the 12 and 26 parameters, they are not representative of current conditions anymore. And then we look at the 9 period moving average, which even more doesn't make sense. In the first place, in the old system, it corresponded to 1.5 weeks of data, which is like, why 1.5 weeks? And now when we have 5-day work weeks, basically 9 days is like this Monday to next Thursday. Like, why? And yet there are people who still insist that you should use the default parameters for the MACD indicator. Even though the default parameters, they are completely irrelevant because they don't reflect the current market situation. Now, if you use irrelevant parameters on an indicator and somehow it still manages to work, then I wonder, if we just randomly throw some numbers in, is that gonna work as well? Secondly, if you have actually watched the video up until this point, you will have seen how much effort it has taken me to explain how this indicator works. And that's because it is basically a derivative of a derivative of a derivative. In the first place, moving averages are a lagging indicator in that it helps us to process historical price information, but it has no ability to predict where the market is going to go tomorrow, next month, next year. It does not have that ability. And this indicator is taking the lag a few steps further by giving us the distance between two moving averages, and then the moving average of the distance between two moving averages, and then the distance between two moving averages and the moving average of the distance between two moving averages. Yes, laugh, go ahead. Ha 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 ha. I know, it sounds absolutely ridiculous. I've said this before in other videos. Lagging indicators, it doesn't actually give me any useful information. And the MACD is even worse because the MACD is like a lagging indicator on a lagging indicator. And yet somehow the MACD indicator is very, very popular. Many people would swear by it. They sell it, they would promote it, they would tell you that, oh, this is the holy grail that's gonna make you a billionaire overnight. But ask yourself, why? Who are the ones that are promoting technical indicators? What exactly are their motivations? Alright, so personally for me, instead of lagging indicators, I personally prefer to use leading indicators, and these are the ones that can give us a sense of how the market might potentially respond to certain events and allow us to anticipate potential movements in the market. Now, trying to understand leading indicators, it takes more work and it involves a lot more analytical thinking. And at the end of the day, right, discipline is the most important thing when it comes to trading and investing, as well as how do we manage our risk. Now, these are all topics that I'm going to cover as we go along in this channel. Do help me out by letting me know what it is that you want to learn. If this video today has been helpful for you, and I really hope that it has, do leave a like, do leave a comment, subscribe. Let me know as well if you would like me to cover more of other technical indicators. Alright, so that's it for today. I'll see you in the next one.